Today, oil, the last holdout? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, once again, the markets were weaker in the US on Tuesday. As well as inflation fears and interest rate hike concerns, falls were triggered by an 8% slide in Goldman Sachs shares after Wall Street's premier investment bank missed quarterly profit expectations, hampered by weaker trading revenues and rising expenses. That share decline put Goldman on course for its worst single day showing since June 2020, shedding about $10 billion off its market valuation since Friday's close, although it did recover to trade down about 6.5% towards the close. The earnings miss triggered further selling on Wall Street banks. Morgan Stanley, which reports quarterly results on Wednesday, was down nearly 5%, while JP Morgan added to losses from a week earlier, down more than 4%. We're seeing a repeating story here, with bank stocks reporting lower than expected earnings. Bank earnings in the fourth quarter have taken a hit from lower trading volumes as the Federal Reserve slowed the pace of its asset purchases after 18 months of pumping liquidity into capital markets to ease the impact of COVID-19. The Fed's intervention has fueled trading activity as clients bought and sold more stocks and bonds, repositioning their portfolios to match the changing economic environment. But fourth quarter earnings from large US banks have showed the market backdrop returning to more normal levels. With its capital market focus, Goldman had been one of the main beneficiaries of market volatility since March 2020, enabling its fixed income and equities traders to enjoy their best period since the 2007 to 2009 financial crisis. But revenue from global markets fell 7% in the fourth quarter to nearly $4 billion, owing to declines in both equities and fixed income trading revenues compared to a year ago. Goldman Sachs had an impressive record year, but a thud of a quarter, said Viola risk advisor analyst David Hendler. Since taking over the reins from Lloyd Blankfein in 2018, Goldman's chief executive David Solomon has looked to diversify the bank's revenue with an aim to focus more on predictable revenue streams like consumer banking, wealth and asset management. The strategy aims to reduce the bank's reliance on unpredictable capital markets-focused business. However, the bank's global markets division, which houses its trading business, still accounted for more than one-third of its revenue last year. Aside from the trading slowdown, Goldman was also handicapped by a 23% rise in operating expenses, mainly reflecting higher compensation and benefits costs. Wage inflation has crimped banks' profits as top Wall Street banks have raised salaries for junior bankers, in particular over the past year, to attract and retain top talent. Oppenheimer analyst Chris Kowalski expressed surprise that Goldman's compensation ratio, which measures the proportion of a bank's revenues set aside to pay staff, has risen during the quarter. This is the first time we've been covering the stock, where the ratio increased from the third quarter to the fourth quarter, he said. Goldman has traditionally been one of the best paying banks. Our philosophy remains to pay for performance, and we're committed to rewarding top talent in a competitive labour environment, Chief Financial Officer Dennis Coleman told analysts in a conference call. For the year as a whole, Goldman's compensation rate was 200 basis points lower at 30% than it was the year previously. Last week, top executives of JP Morgan Chase, the country's largest bank, flagged similarly high fourth quarter expenses and saw its shares fall 6%. Like its rivals, Goldman's trading slowdown overshadowed a 45% jump in investment banking revenue to $3.8 billion as its top rainmakers raked in record fees from advising on some of the largest mergers and initial public offerings. The bank's investment banking pipeline remains strong heading into 2022, Solomon told analysts. And Solomon acknowledged last year was an exceptional one in terms of client trading activity, but said he anticipates more market volatility than usual in 2022. Activity levels, given we're in a very unusual macro environment, are going to continue to be reasonable as we start into this year, he told analysts. You've still got a lot of volatility around the pandemic. The bank expects to hold on to market share gains made by its trading businesses even as the market environment returns to normal, executives said. Goldman's profit fell to $3.8 billion in the quarter, compared with $4.4 billion a year earlier. Earnings per share fell to $10.81 from $12.08 a year earlier, and analysts on average had expected a profit of around $11.76 per share. So, stocks fell across the board and Treasury yields surged amid a ramp-up in speculation that central banks will have to boost interest rates sooner than anticipated earlier. All but one of the 11 industry groups in the S&P 500 fell, while the Dow Jones Industrial Average headed for its biggest daily decline in a month. The Nasdaq 100 sank more than 2%, dragged lower by big techs such as Apple and Meta Platforms. And Microsoft retreated, spending $69 billion to buy Activision Blizzard Inc. Acquiring Activision will help jumpstart Microsoft's broader gaming endeavours and ultimately its move into the metaverse, with gaming the first monetization piece of the metaverse, in our opinion, Wedbush said in the note. Treasuries fell along the curve, pushing yields up to levels last seen before the pandemic roiled markets, and benchmark German yields rose to within 1 basis point of turning positive for the first time since May 2019. Focus is sharpening on the US Federal Reserve's March meeting, with markets starting to consider pricing more than a 25 basis point increase. High interest rates are going to be here to stay, and that has to factor into everyone's decisions, not just those that are borrowing capital, but mostly in terms of valuations. Julie Beal, portfolio manager and senior research analyst at Kane Anderson Rudnick, said. So those super high-flying narrative-driven tech stocks are going to continue to take a beating. Oil surged to the highest level in 7 years, underscoring the inflation challenges facing the Fed. Meanwhile, a gauge of New York state manufacturing slumped in January as measures of orders and shipments retreated sharply, suggesting the Omicron variant of the coronavirus caused a pullback in activity. Global equities have had a volatile start to the year as investors shift out of more expensive and rate-sensitive sectors such as technology into cheaper so-called value stocks. Bank of America January Global Fund Manager surveys showed that net overweight positions in the tech sector fell to 1%. That's the lowest since 2008, though they expect inflation to fall this year and are placing record bets on a boom in both commodities and stocks overall. The question investors are wrestling with most is if the Federal Reserve will need to tighten monetary policy to guide inflation lower, or if a softening in economic growth will allow the central bank to be less aggressive in tightening, according to Dennis DeBusschere, founder of 22V Research. The former would be terrible for cyclical and technology shares, he said. The closely watched short end of the Treasury saw the 2-year yield surge to trade back above 1% for the first time since February 2020. The 10-year yield reached a 2-year high of 1.86%. The really big thing, in my opinion, is to see the 2-year rate back where we saw it in February 2020, J.J. Kinaham, chief market strategist at TD Ameritrade, said. The 2-year is closer to what the Fed will be doing, so I think it really signals something that's aggressive. We also see more opportunities in cyclical and growth sectors, driven by the tailwinds from continued economic growth, a higher interest rate environment, stronger commodity prices, and our preference for higher quality companies amid many uncertainties in 2022, Wells Fargo said in the note. We are seeing broad-based de-risking once again this morning as traders and investors remain focused on inflationary pressures and potential Fed action just ahead, January Montgomery Scott said in the note. The street has priced in up to 4 rate hikes this year, but concern is growing that something must be done sooner than anticipated. The 2-, 3-, and 5-year part of the yield curve will bear the brunt of expected Fed policy, said Tom DeGolama, a managing director at Seaport Global Holdings in Greenwich, Connecticut. The front end of the market is still way underpriced for Fed tightenings. The 2-year note could be 1.5% by March, he said. The 2-year Treasury yield rose 7.3 basis points to 1.040, and the yield on the benchmark 10-year Treasury note advanced 9.3 basis points to 1.865%. Yields have jumped since minutes viewed as hawkish from the Fed's December policy meeting showed it may raise rates sooner than expected and begin reducing its asset holdings to slow inflation and to address a very tight labour market. Securities will continue to revalue as the market anticipates rate hikes, said Michael O'Rourke, chief market strategist at Jones Trading in Stamford, Connecticut. We still have a bit of a ways to go to prepare for 3 rate hikes or 4 rate hikes. We haven't priced that in, he said. Big market declines often occur in years following outsized gains on Wall Street. There have been 9 sell-offs starting in the first quarter that averaged 10.9% since World War II, said Sam Stovall, Chief Investment Strategist at CFRA Research. However, history is a great guide, but it's never gospel, he said. Gold prices fell. US gold futures were down 0.2% to 1,812. And stocks and bonds are out, but oil is in, at least for now. That's the playbook for hedge funds trying to navigate persistent inflation, rising interest rates, and a slumping tech-heavy equity market. Oil was the only positive sector on Wall Street as Brent crude prices hit $88 a barrel after Yemen's Houthi group attacked the United Arab Emirates, escalating hostilities between the Iran-aligned group and a Saudi Arabian-led coalition. Hedge funds are the most bullish on oil since mid-November, based on the combined net long positions in Brent and West Texas Intermediate crude futures. The positions have been building over the past 4 weeks as 10-year Treasury yields jumped 50 basis points and the Nasdaq 100 index tumbled 5.5%. Rising risk hike bets from hedge funds are a big driver of the tech sell-off that spilled over into the S&P 500 index. Oil, meanwhile, is heading in the opposite direction, with WTI and Brent hitting the highest level since 2014 on Monday. Federal Reserve tightening cycles have historically spurred rallies in cyclical stocks. The problem is that for that to happen without tech requires strong gains in value sectors, and that's usually accompanied by breadth, meaning small cap stocks would be gaining too. But investors remain less optimistic around the Russell 2000, which is down 3.7% since the start of the year. That could be why hedge funds seem unwilling to bet on a reversal of the 15-year downtrend in value. Instead, they're once again turning to commodities in search of returns. Oil prices have been buoyed by increased demand as the global pandemic gradually recedes and rising geopolitical tensions. Drone strikes on the United Arab Emirates have created risk in a critical oil exploring region. On top of that, prices are getting support from concerns that Russia may only meet half of its scheduled output over the next 6 months, despite calls to hike output faster. And in expectations that energy prices will be an ongoing driver of persistent inflation, and there's little mystery as to why hedge funds are pulling out of collapsing stocks and bonds and turning instead to commodities in search of precious returns. Oil continues its relentless climb on Tuesday. The Iran-allied Houthi movement launched drone and missile strikes on Sunday, the set of explosions in fuel trucks in the United Arab Emirates that killed 3 people and warned that it would target more facilities, prompting Abu Dhabi to say that it reserved the right to respond to those terrorist attacks. OPEC, which stands for the Organization of the Petroleum Exporting Countries, meanwhile stuck to its forecast for robust growth in world oil demand in 2022, despite COVID's Omicron variant and expected US interest rate hikes. Those long the market use that as further leverage in their bid to get crude to their first target of $90 a barrel and eventually beyond $100. The WTI intermediate benchmark for US crude settled up 1.9% to $85.43 per barrel for its highest close since October 2014, and WTI is up around 13% since the start of the year. Crude prices initially lost 20% of their value shortly after the Omicron variant was discovered. In November, they ran up again as underinvestment and outages prevented some producers within OPEC to pump at their allowed capacities under an agreement between the group, Russia, and allies known as OPEC Plus, to add 400,000 barrels per day each month. If current geopolitical tensions continue and OPEC Plus members can't deliver on their 400,000 barrels per day increase, macros coupled with the strong technical outlook could see prices pushed towards the $100 mark, which is where the next meaningful technical resistance level lies, Ash Glover at CMC Markets was quoted saying by Reuters. Even so, some of this year's rally in oil seems built on hype more than fact. The so-called tighter market for oil that has underpinned the rally conflicts with the 21-month high in gasoline stockpiles reached after consumption cratered when the holiday season between late November and December ended. That makes the weekly inventory update from the US Energy Information Administration due on Thursday the last piece of demand jigsaw puzzle for oil. After 2 straight weeks of huge gasoline builds, the EIA could report a substantial draw that could further add longs in the market. But even if the EIA issues another negative data set, the upward momentum in oil might not let up as Wall Street banks from Goldman Sachs to Bank of America cheer hoarsely from the sidelines for a $90 and above crude. It's a bull's dream what's happening in crude oil now, said John Kidduff, partner at New York-based energy hedge fund Again Capital. The narrative we're hearing about tight OPEC production is old news. The EIA gasoline numbers is the real news, but that has been ignored for 2 straight weeks now. And this is the point. There is really nowhere to hide, and even the oil story is one that, when you look deeply, is also suspect. We are very much in a difficult time in the markets at the moment. I expect more falls ahead, and it looks to me as though the falls are beginning to build to something substantive, and we could start to talk about corrections and things like that. And once that starts, the self-perpetuating feedback loops on the negative side could drive stocks significantly lower. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.